In his book One Up on Wall Street, Peter Lynch writes that the perfect company is doing something dull in a disagreeable non-growth industry, has something depressing about it, and people still have to buy it. And if coal companies doesn't match this description, I don't know what does. Coal is a resource that has long been declared dead, at least in the Western world. But there is another super investor out there that is currently buying coal companies like crazy. So, does he know something that we don't? By the end of this video, you will know why coal is an interesting investment right now and what many of the companies in this sector have in common. I'll also show you some concrete examples of coal stocks that super investors are buying right now. And to get this out of the way from the beginning, I am all for green, renewable energy and for keeping our planet alive. Hell, I am one of the people who even read the whole IPCC climate report just to get the facts about the climate change from first hand. But we are not here today to talk about climate change or politics and whether they make sense or not. As a physics engineer, I am all about hard facts. So let's have a look at these facts related to the coal industry and see if we can learn something that helps us improve our investments. My name is Florian, welcome to Cashflow Maniac. In our Western world, coal is often perceived as a dying resource that in the future will mostly be used for barbecues. But this couldn't be further from the truth. The reality is that the coal consumption has reached new highs in 2022 and again in 2023. By far the biggest consumer is China, followed by India. And while the coal consumption in China is expected to stagnate in the next few years, the demand in India is just beginning to pick up. Right now, more than 1/3 of the global energy generation is still produced with coal. Renewables are growing quickly and can slowly win market share overall, but the biggest increase in electricity demand, with around 5% per year, is still going on in Asia and Middle East, while it is decreasing in both Europe and North America. Right now, more than 1/3 of the global electricity generation is produced with coal. Renewables are growing quickly and can slowly win market share overall, but the biggest increase in electricity demand with around 5% per year is still going on in Asia and Middle East, while it is decreasing in both Europe and North America. And on a global scale, there are currently still more than 200 new coal plants under construction, with another almost 100 more projects being announced and 260 in pre-construction phase. That is a total of 550 projects. Most of them are being realized in China, India and Indonesia, where coal is still the primary energy source. The global coal consumption, however, is expected to decline from here on onwards, with a small annual decline of 0.7%. But this hugely depends on the general economy and the electricity production in China. It is also not the first time that a decline in coal demand was expected, and in the end, the demand still further increased. But coal is not only used for electricity production. Some essential building materials are produced using coal, like for example cement. And while coal is not a direct ingredient in cement, it still plays a huge role to generate the heat required to fire the kilns that produce the cement, and also as a source for fly ash. Another critical material where coal is even more important is steel. 70% of steel produced today is made using coal. In 2023, by far the biggest use of steel were buildings and infrastructure. 52% of the globally produced steel was used for this sector. And that includes the infrastructure for renewable energy sources like solar or wind. In fact, each megawatt of solar power requires up to 45,000 kilograms of steel, which requires 31.5 thousand kilograms of coal. An average wind turbine requires even 160,000 kilograms of steelmaking coal. So coal is absolutely necessary in order to build up our renewable energy sources in the first place. Because of this requirement, steelmaking coal is also part of the commodity supercycle. But more on this later. You might think now, but Florian, there is currently a trend going from coal to hydrogen for steel production. And you're right. But the overwhelming majority of steel over the next decades will still be produced with coal. Steel produced with coal is shown in blue and green colors here, while steel with hydrogen is shown in yellow and orange. The gray part is the usage of recycled scrap. Depending on the different scenarios, in the Stated policy scenario or STEPS, coal will still be used in 52% of all steel production in 2050. And even in the more optimistic Sustainable Development Scenario or SDS, coal is still used in 43% of all steel production. Of course, these percentages are not very meaningful if we don't know the development or trend of the overall steel production. So let's have a look at this now. In the baseline scenario of the International Energy Agency, they expect the global steel demand to increase by more than a third between 2019 and 2050. So it is fair to say that we still have a secular trend here and that the steel demand, as well as the demand for coal for its production, will stay high, if not even further increase. But before we take action now and buy the next best coal miner, we should be careful. Because coal is not the same as coal. Indeed, there are 4 different types of coal, and please excuse me when I butcher the names. Starting from the bottom of the list, lignite or brown coal is the lowest quality of coal and has the lowest heat content as well as the lowest carbon content. Sub-bituminous coal or black lignite has a higher quality coupled with a higher carbon and also heat content. This type of coal is the most common, with around 30% of all coal resources being of this type. Sub-bituminous coal is mostly used for energy production. Bituminous coal or soft coal is again a step up from the previous form, and the carbon content as well as the heat content are quite a step up from the sub-bituminous. This coal is ideal for steel production but can also still be used for energy generation. Last but not least, the highest quality of coal is called anthracite or hard coal. It has the highest carbon and heat content and when burned can reach very high temperatures. It is also one of the cleanest types of coal to burn, producing less smoke than other types. However, this type of coal only makes up around 1 to 2% of the overall global coal production and is therefore quite rare. The coal used for steel production is called metallurgical or just met coal and is usually at least bituminous or higher grade coal. But be careful here, as some companies have different kinds of definitions of metallurgical grade, and the market price for this kind of coal can also vary greatly depending on the quality grade. The consumption for specifically this metallurgical coal is expected to increase in the next years, with the biggest increase coming from India. India's steel production is indeed a very interesting topic because it is expected to grow its market share from around 5% today to 20%. Even today, they are already the second biggest steel producing country in the world. Tata Steel, India's largest steel producer and one of the world's leading steel producers, for example, already has plans to double the steel production capacity from 21 million tons per year to 40 million tons per year. And in India especially, the energy for the steel production is also expected to come mainly from coal until at least 2040 or 2045, when it shall be switched to hydrogen. So, when looking at these facts, it seems like coal is still here to stay for a little while longer, whether we like it or not. It is still the dominant fuel for power generation, and especially China is further expanding their coal power production. And while the overall global coal consumption is expected to decline, the demand for metallurgical coal should increase or at least stay stable until 2015. This higher quality coal is also getting rare and there are not many untapped depots anymore. Before we look at some concrete companies now to see what makes an investment in the sector even more interesting, if you like the video so far, please leave a like and subscribe to the channel. As a small channel, this is helping me out a lot. Thank you so much. In the beginning of the video, I mentioned that the coal mining industry fulfills some of Peter Lynch's investment criteria. But there is another super investor out there that is currently holding not 1, not 2, but 4 coal miners. And that investor is actually the writer of an investment book that I can warmly recommend, The Dundo Investor, and it is Munish Pabray. In his US portfolio, Munish is holding 4 coal companies and only these 4 coal companies, nothing else. So he is betting heavily on this industry. These companies in his portfolio are Alpha Metallurgical Resources, Consol Energy, Warrior Met Coal and Arch Resources. But before we jump into some more details of each individual company, let's first compare the performance of these 4. And totally return-wise, all of them did outperform the general market in the last year, with AMR having the best performance with over 70% return in 1 year. How is that for a boring and dead resource? With only 40% return, Arch had the worst performance of the bunch. On a 5-year basis, the picture looks similar. AMR did again clearly outperform their peers with almost 500% returns. The worst was Arch again, but it could still beat the S&P 500 with 120% returns. And when we zoom out to 10 years, we have the same picture as AMR leads the pack with almost 2000% return. Arch is again the worst of the bunch, but they could also still outperform the S&P 500, if only very slightly. Despite this amazing outperformance, the valuation of these companies doesn't seem high. Here we have PE multiples between 6 and 7, with Consol Energy being the lowest with 6 and Arch the highest with almost 9. EV to sales differs a bit more between 0.9 for Arch and 1.6 for Warrior Met Coal. Price to cash flow in contrast is remarkably similar at 4.3 times, with only Warrior Met standing out with a multiple of 5.3. Unfortunately, we also see that the revenue did decline over the last year for all companies, and it is also expected to decline this year in all cases except Consol. In the last 5 years though, all companies could increase their revenue, with Consol even having double-digit growth rates. And Consol is also the only company that could grow the net income in the last 3 years. The free cash flow shows a similar picture, with only Consol and Alpha Metallurgical being able to grow their free cash flow. The time frame of 3 years might have something to do with this, because the coal price has been very high between the middle of 2021 and the beginning of 2023. And it is not surprising that the revenue and net income from coal miners declines when they can't sell their resources at these elevated levels anymore. But this temporary price increase has flushed quite some money into the pockets of these companies, and all of them have more cash on their hands than debt in their books. Profitability-wise, Met Coal and Consol stand out amongst these peers with very high gross profit margins, way higher than the sector median of 28%. The net income margin of these two companies is also the highest, but in this case all of them are quite a bit above the sector median of around 5%. So now that we saw the comparison of these 4 companies, let's have a bit of a deeper look and especially focus on the production of metallurgical coal, because as we established earlier, this is the quality group where the future growth is expected. So let's start with Alpha Metallurgical, or AMR. AMR is the biggest met coal producer in the US and accounts for 20% of the total metallurgical coal production. They own 21 mines and produced 60.7 million tons of coal in 2023. More than 90% of the coal produced by the company is met coal. And for 2024, they even expect that non-metallurgical byproducts only make up around 5% of their total production. The average price they expect for each metric ton sold in 2024 is $155.5. The company is also heavily buying back shares, and in the last 2 years they did already decrease their share count by around 1/3. So they are using a lot of cash to return to their shareholders. And this is not the end. The current stock buyback program has still more than $500 million open. If AMR continues with this trend, such buyback programs alone can deliver shareholder returns of around 13% next year. The next stock on our list is Warrior Met Coal. This company only has 4 mines with which they produce 7.6 short tons, which is an equivalent of around 8.5 metric tons. So the total production is around half of AMR. With a selling price of around $260 per ton, they do however have the higher quality coal compared to AMR and can achieve higher prices. The company is not buying back shares right now, but instead is paying and increasing a regular dividend and a special dividend. The current dividend yield sits at only 0.5%, but in the last 3 years they could grow the dividend by over 18% annually. In good years, they are also paying a special dividend. But the company is not only returning money to their investors, they are also working on their Blue Creek project that is one of the last remaining untapped high-quality coal reserves in the US, and that should start production in 2026. I would also expect that after the current capex cycle, the company will also start returning cash to their shareholders with higher urgency. Consols Energy is the operator of 4 mines in 2 mining complexes, one of them being the Pennsylvania mining complex. And although their share of thermal coal has steadily decreased since 2017, revenue from met coal still only makes up less than 20%. So the quality of the coal mined is much lower compared to the other 2 companies. In the last couple of years, the company has used much of their free cash flow to decrease their debt by almost 80% since 2017. But since the beginning of 2022, they also bought back around 80% of their shares. The company also wants to use at least 75% of the cash flow next year for stock repurchases. Consols Energy also owns their own shipping terminal. Unfortunately, it is located in Baltimore and was blocked due to the collapse of the Francis Scott Bridge in March. This has temporarily limited the ability of the company to ship coal and might also have an effect on the full year results, even though the company has tried alternative strategies to offset this impact. Last but not least, Arch Resources is operating 7 mines and generates around 80% of their revenue with met coal, and they even claim that around 30% of the global High Vol A coal, which is a high quality coking coal, is produced by them. Compared to AMR and MET, their percent of resources exported, and especially exported to Asia, is quite a bit higher. Arch is paying a dividend with a yield of around 3% and a payout ratio of slightly above 50%. They did not grow this dividend on a regular basis in the past though. The company has also just started to buy back shares, and they have reduced their share count by 3% in the last quarter alone. In the future, they are planning to keep their capex to a minimum while returning 100% of their discretionary cash flow to their shareholders, with an emphasis on share buybacks while only maintaining the dividend. It is really interesting to see that 3 out of these 4 companies are planning to buy back shares on quite a high level in the next years. And some of them have already reduced their outstanding shares quite significantly. Companies like this are called super cannibals, and since 1992, such super cannibals could deliver returns of 15.5% per year, which is quite an outperformance compared to the S&P 500 with around 10% return annually. Our super investor from before, Munish Pabre, shows us here why this is so incredible. Basically, companies that are repurchasing shares can multiply the returns for their shareholders. And this gets crazy when around 80% of the shares are bought back. From here on out, the shareholder returns explode. But buybacks only make sense when they are done at reasonable stock prices. And as we saw before, the valuation of these companies is currently quite low, while they still generate some impressive cash flow at good to great margins. So I think it is fair to say that in this case it is a good idea and definitely does make sense. And this gets especially impressive when we compare the cash flows with the current market value of these companies. At the moment, it seems that these companies can generate their whole market value in cash flow over the next years. But of course, there are also always risks. And 2 risks come to my mind here immediately. First, the cyclical nature of the resource and the coal industry, and second, the dependency on the demand from India and China. But with the huge share buybacks, I also think that these companies do build a kind of a safety buffer against such risks. So what do you think about an investment in the coal industry? Do you think this sector and the companies I mentioned today will be interesting over the next years? And which of these 4 companies do you like most? What I didn't mention up to now is that amongst other resources like copper or oil, the resource supercycle might also have an impact on the coal business. If you want to learn more about a resource supercycle, what it is, whether we are in one or not, and most importantly, how to invest in a resource supercycle, I have a full video where I go over all the details right here. And if you don't want to miss out on my next video, please subscribe to the channel and smash the like button. That being said, thank you so much for watching, guys, and see you in the next video.